All right, so I want to thank everybody who is here today. Sorry we had a few technical difficulties. My name is Olivia Amundsen. I am one of the cow-calf field specialists here at SDSU. Warren asked me to moderate for him today because he was unable to be here. Because we are running a little bit behind, I'm not going to go through all of the housekeeping items. Instead, we'll have all that information in the chat box. So if you guys have any questions regarding that, just type those answers or questions in the chat or Q&A box. Otherwise, we are not going to hesitate to get started. I am going to introduce Dr. Matt Diersen. He is the SDSU Extension Risk and Business Management Specialist, as well as professor here at SDSU. And today he's going to be talking to you about cattle feeding risk management. So Matt, I will let you take the floor.
Thank you. Good afternoon, everybody. We'll be taking a look at cattle feeding risk management today. I am coming to you from the Ness School of Management and Economics at SDSU. If you are looking for additional supporting resources, much of what I am covering today has been covered in some way, shape, or form on the extension sdstate.edu website. I've done quite a bit of work in the last year and a half or so through the LMICs in the cattle markets and then through trade publications as well. So there is some backing, there is some information to back up what I cover here today. Here's an outline of my talk. Just a second here, an outline of my talk. We'll first take a look at, oh, it's not cooperating, there we go. We're first going to take a look at some of the market disruptions that have happened to set the stage for why we would be looking at managing risk. And then here are some of the major tools for how you would manage risk. We've got some pricing tools, that'd be futures, cash market, forward contracting, and then we also have some protection tools. The main focus there is going to be on put options, but I do want to highlight both livestock risk protection because of some recent changes to that program. And I'm going to take a quick look back at what was called livestock gross margin, another kind of insurance. I thought this was maybe something that would be useful for something like the COVID-19 problems, but we'll see when we get there what happened with that particular product. So we'll start by taking just a broad view of what's happened to the markets and what things look like. So when COVID hit, that took federally inspected cattle slaughter way down compared to normal and way down compared to a year ago. Cattle just flat out were not being processed. Generally, you think of cattle being non-storable. You can't really put the cattle in a bin somewhere and harvest them at a later date, and that has implications for price expectations and when and where you think they'd be marketed. Usually the cattle are designed to be finished at a specific point in time and then sold in the market at that point in time. Well, that slowdown in slaughter has come back a little bit, but one of the implications of delaying some of the pace of slaughter has been a marked increase in slaughter weight. So here's just the all cattle dress weight, and that has gone up a little bit seasonally, but it's increased earlier, and the weights are at a much higher level than we had a year ago, and of course compared to the 5-year average. So implication of storing the cattle was they got bigger through this time period, and that's expected to continue until some or most of the backlog of market-ready cattle is worked through. Another area that this, or implication of the slowdown in the slaughter pace was on the feeder cattle side of things as well. So here we've got a look at the feeder cattle from cattle inventory report, and we've got here the feeder cattle supply outside of feedlots. My mouse won't cooperate here. Here we've got the 2020. So July 1, the expectation was for feeder cattle outside of feedlots to be below a year ago level, but with the slowdown in placements, there are actually a greater supply of feeder cattle outside of feedlots on July 1 than a year earlier. So that slowdown there too needs to be worked through. So what were the implications of that combination of things on prices? Get the slide to advance here. Just a little
Matt, will your arrow keys move? Will the arrow keys on your keyboard move the slides?
Yeah, I can try that as well. It's a little sticky with the multiple screens going. So what was the impact on price? Here we've got the August live cattle futures price, and these are year-to-date prices, so the beginning of the year till about last weekend, just to give some idea of what happened to futures prices during the whole spring and early part of summer here. So the expectation for August would have been fed cattle in the neighborhood of 115 to 120, and of course when COVID really disrupted the markets in March and April, that price got down right at about $80 and in a sense climbed back up to the low 100s. So what we've got is this whipsaw area of prices through here. That is the type of risk that the feedlots are looking to offset or lay off or move on to another party rather than face it themselves. Now, the same thing that happened while this occurred, so I'm going to overlay the futures prices with another indicator here. I'm going to overlay this with the implied volatility in the market. Now, normally in live cattle, fed cattle futures, the volatility tends to be, let's say, 10 to 20% on an annualized basis. But as we got into March and into April, the volatility moved up to, you can see here on the right-hand side, 40%. So that volatility level, I was teaching class last spring and I was trying to compare it to something, and I'm like, well, early on it passed the level we saw in 2003 with the BSE scares. It's also greatly expanded relative to what was seen more recently during the 2008, 2009 Great Recession area, where volatility in all markets went up as there was a flight from anything risky into quality. Well, that same thing happened in the live cattle. As the price levels fell, the volatility increased, and that was a double hit to a feedlot, for example, that hadn't made any decisions, was looking to do something. You're facing lower prices and higher volatility. So the cost to lay off the risk in this market skyrocketed at the same time. So here's the combination of things that happened. During the COVID scare, restaurants started to close, packers were having woes, pseudo meat started to grow, and the supply chain partners became foes. I couldn't resist. Had to do some poetry. The markets were a mess. The markets are a mess. It's as frustrating as getting your kite stuck in a tree. This kite got stuck in this tree at the beginning of spring, just as the COVID scares were starting and the pandemic was really starting to move through the United States. It's a lovely dragon kite, and it's tempting at this point to really be mad about the markets and prices and everything else, but I throw this out there. It's not the kite's fault it got stuck in the tree. We can still fly kites. We can still like the markets and use some of the market tools. Okay, enough comedy from an economist. What does this mean going forward? What are some things that a feedlot could do to manage risk during situations like was experienced during the spring, but also just in general or moving forward? Well, start by taking a look at the cash market. If you're not doing anything, you have to sell in the cash market, or even if you are managing risk, you still ultimately need to sell in the cash market. Here's a price comparison for Sioux Falls Regional Livestock. For outside viewers, Sioux Falls Regional is an auction sale barn. It is a CME delivery location located just south of Sioux Falls. Has an active fed cattle and feeder cattle market. It's got a nice price history available. So what happened in 2020 compared to 2019? During 2019, a very typical seasonal pattern was present in the cash market. 2020, it adjusted or moved away from that normal seasonal pattern. Huge decline in the cash price level compared to 2019 or compared to a year earlier. That was unexpected. So that price level was a result of the COVID disruptions, but at the same time, these cash prices on a week-to-week basis were never as volatile. They never went up as high or down as low as the futures prices did. So the futures prices in general, as more of a leading indicator at times, tend to be show much more volatility or much larger swings up and down than the cash market did or normally does. So it's not unusual, but it was just interesting to go back and make that comparison. If you're in the cash market, you're sitting here at a point in time, and I'm using an imaginary set of prices, just round number. If the price was $100 a hundredweight, so think about a fed cattle price being this at this time. If you're looking at the futures market down here, and then the cash price over here, if you're in the cash market, we say you're long cash. You will be selling in the cash market in the future. And if the price level were to fall from, let's say, $100 today, or point A here in the middle of the screen, if the price were to fall between now and when you actually sold the cattle, that's the risk. That's risk that you have as a cattle feeder. So that's the bad thing that can happen. That's what you're trying to manage. And being in the cash market means that if you're not doing anything and you get to the sale time and the price has fallen, it may have knocked out any profit margin you were expecting to have. So that's why in the cash market, since you're ultimately going to be in the cash market, you look for other ways to manage your risk in the meantime. One popular way that risk does get managed is through forward contracting. Here's a chart this is from a month ago when I took a snapshot look at what happened with forward contracting through the COVID problems up until this was as of a month ago. This was as of the beginning of June compared to a year earlier. And after the COVID disruptions had started to move through, forward contract volume on fed cattle had fallen substantially compared to a year earlier. So there is a forward contract market. As a feedlot, you would line up to sell your cattle to a specific packer at a specific time with a specific basis, usually relative to futures. And we can see that during the COVID, all the packers shut down and all the feedlots were like, oh, we can't agree to buy and sell cattle at this time, and the volume on the forward market dropped way off. It has since come back a little bit more, but through August, really there was, I looked up the number this morning, there were still just over 100,000 head had been contracted for August delivery. September, October, November have all increased up to 150,000 head. So for these 3 months here, volume was approaching where it was a year ago at this time for delivery in those time periods. So implications are that there would still be room for more cattle to be forward contracted, setting up or assuring a destination for fed cattle. If you are interested in that report, it is currently named the Prior Week Slaughter Forward Contract Purchases and Packer-Owned Cattle Report. Hesitate to provide a web link for that. That's an AMS price report, and if you hunt long enough, you'll be able to find it. Or you can always use the old Google and search for it that way. But gives a good indication of basis bids and price levels. That forward contract volume tends to be about 5% of the market, and that drop off has happened here recently. What's the implication of forward contracting? Well, if you forward contract, if that price is $100 today, and you sign a forward contract, you fix the price. It is set. So no matter what happens to the futures price between now and when the cattle are ready, you're going to receive your contracted price. So that's good. It gives you an alternative, and it fixes that price. If, on the other hand, you stick with the cash market and then use the futures market, you can place a futures hedge, which is going to result in a similar outcome. So here I have a combination of things. Again, you're not forward contracting here, so you are still long cash. So you will be selling in a cash market at some point, and without a futures contract, a decrease in the futures price would result in lower returns. So we're in return space here. I am missing the short future should be in this little box up here. It's a glitch when you mess with PowerPoint and Zooms and 16 streaming things. So that line there, the dashed line, is a short futures position. So if you're going to be hedging fed cattle as a seller of fed cattle, you would sell futures, taking an opposite position in the cash and the futures markets. The other party in this futures position is very, very likely a speculator. It could be a packer taking a futures position on the opposite side, but odds are it's a speculator, and the speculators were the ones that were affected as the price fell during the early part of spring. What happens when you combine this long cash and short futures positions together? Well, they cancel one another out. A gain in the futures will offset a loss in the cash and vice versa, resulting in an expected price that matches up, in this case, exactly with the forward contract outcome. But both of these say that either hedging or using a forward contract, you're knocking out the cash price and returns being lower as cash and futures price fall. How do you tie those together, and what are the implications for cattle feeding and managing risk in that setting? Well, a few things to remember. Even though I showed that the market right now is sort of trying to store cattle or delay the market in cattle, usually cattle are considered an unstorable or non-storable commodity. It tends to have to be sold when it's ready. Otherwise, you end up with quality discounts and things of that nature. It's important to remember that to manage risk in this way, you have to do selective hedging, because always contracting, always being cash, or always hedging cattle for delivery 4 months or 6 months ahead of time is going to result in the same outcomes. So the way to benefit from hedging is to hedge when it makes sense or when the profit margin is there to do so. It's called selective hedging, or hedging when it's good enough or better than the alternative outcomes. So you want to keep that in mind. And I think what we really saw, at least in the last 6 months, was some of the stark differences between forward contracting and futures. With the forward contract, it did line up a buyer. At the same time, it brought on relationship risk. So if a particular packer was unwilling or unable to take the cattle when they were ready, they were finding alternative markets for it. With the feedlot, you're just setting yourself up to be at the mercy of a particular packing plant at the time the cattle are to be delivered. I hadn't heard any problems. I assume that they tried their best to honor those forward contract situations. Otherwise, it's going to cost them customers down the road. So from a feedlot perspective, it may have worked out okay. At the same time, it does introduce that relationship risk. Now, the futures side of things, futures do require brokerage and margin accounts, but futures are technically deliverable. So much like me getting mad at my kite stuck in the tree, did hear some at least concern or rumblings about feedlots being dissatisfied, unhappy with the futures market. Hopefully that anger was a little bit misplaced, because I think the futures market functioned fairly well during this whole episode, and that deliverable feature kind of came into play very quietly down in the southern plains. There were cattle delivered on the live cattle contract for April delivery. The deliveries went into mid-May, as things were sort of, that's how they just worked themselves out through mid-May. There were cattle tendered for delivery, Kansas, Texas, and other places. It didn't matter from a feedlot's perspective. It's my opinion. It didn't matter from a feedlot perspective where the cattle ended up. They were delivered to their local or nearby delivery location, and then it was on the buyer to take care of the cattle at the futures price paid at the time the contracts were entered. And that's how it went forward. So it would give a destination for cattle in a highly unusual situation like was observed. Basis can influence that choice between those two as well. So take a look here at basis. This is the year-to-date basis. I like to, basis, of course, is defined as the cash price minus, in this case, the nearby futures price. So for July, we've got a July cash price there that was shown in the earlier chart. That's the cash price minus the August, or the average of the August futures prices during the month of July. So cash minus the nearby futures. I prefer to use a 5-year average for fed cattle, just a historic 5-year average. So that 5-year average price there is 2015 through 2019. And then I overlay that with the 2020. So for planning purposes, I'd use that 5-year average. So going into 2020, one would have been expecting basis levels $3 to $5, March, April, May, and June. As it happened, basis was very high or above average or much more positive than expected during March through June. So I think that means, if I've got my story right, that means if a feedlot had been hedged, fully hedged during that time using futures, and then they were to sell, in this case, in the Sioux Falls regional market, they would have come out with a better price than they would have been expecting. So you needed to be hedged and then have a positive basis relative to expectations. And then it sort of averages itself out. As you see, July basis was nowhere near, it's not that far away, but it wasn't as good as basis had been. And it's actually a little bit on the negative side compared to what would have been expected, a slight positive basis during July. Now, basis in those odd months tends to be a lot more unpredictable. But so what's the take home for this? If you are sitting there wondering, do you go with a forward contract? Do you go with futures? Aside from the relationship and the delivery differences of the two, normally, if you're getting a good basis bid, or a basis bid that's reflecting a basis level higher than expectations, then you'd go with a forward contract. And if the basis is not so good, like maybe if a basis right now was a -5 under basis, maybe you say, okay, I think the price is going to revert back to normal. I'd be expecting a 0 basis for August, or maybe a a wide $10 or $12 basis out here. You might say, I'm going to use the futures market instead, thinking that by the time we get to expiration, that basis is going to have narrowed up. So forward contract would fix that wide basis. So that's why you tend to want to use the futures market. At the same time, if the basis was high relative to what you're expecting, then a forward contract would get the nod. Olivia, how are we doing? Any questions coming in? So I'm going to shift gears to a different direction.
No questions at the moment.
Okay, so that's the futures side of things. That's a way to price cattle, and it gives us some idea of the two main ways to forward price and what that might do to mitigate or manage some of the risks. So it's hard to look back and say could have, should have, would have done this or that differently. It does say that the spring hedged cattle would have been okay, but I don't know how many cattle operations tend to 100% hedge the cattle. So a middle ground would be to also consider using some protection strategies. So advance the slide here. When you think about price protection, generally you're thinking about options on futures. For the most part, you're looking at buying put options if you're a feedlot, and that's sort of the default case. Now, there's other kinds of options, and there's other things to consider, but starting with that feedlot with downside price risk on the fed cattle or live cattle, looking at purchasing put options is the starting point for risk management. It does require a commodity broker, again, just like the futures contracts would, and it does require a margin account. You don't necessarily have the margin calls you would have or the susceptibility to margin calls, initial and maintenance margin you'd have with the futures positions, but with an option position, you still end up needing a margin account for the most part. So just go in expecting that. Options settle on the first Friday of the contract month, so the August futures contracts would expire tomorrow, I believe. So the options tend to expire at the beginning of the month, and the futures contracts settle or expire at the end of the month. So good way, another way to maybe manage some of the risk through time, spreading out futures and options positions if there's a lot of cattle, to better time it with the when they're actually going to be sold in the cash market. With options, and this is maybe not terribly huge concern, but you do have the issue of picking a strike price and finding a fair premium to pay. My opinion is that the option market tends to be thinner than the futures market, so I definitely would consider or recommend using limit orders and expect, we certainly saw it this last 6 months, very wide bid and ask spreads, especially as they got closer to the end of the trading day, and that just makes placing orders, getting orders in more difficult in general, so you need a little more patience with the options compared to futures. Various combinations are also relevant. I'm going to show a put option example, but did hear some good results from fence strategies, so buying a put, selling a call, and some different things, and I'll circle back to one more after I show what happened with the volatility. And then another protection tool that can be used is livestock risk protection. I'll highlight a couple of things about that here too. It functions the same as a put option. So let's take a look again at our cash market. So if you're long cash, sitting here facing a futures price today of say $100 a hundredweight, your concern is what if the cash price were to fall, in futures price. So if those prices fall, eats into your profit margin, and nobody likes that. So You could use those forward contracting or futures and fix the price level with some basis risk, but in general, you're fixing the price level or getting pretty close. Another alternative is to use a put option. Now, the put option works like this. The put option has a strike price. In this case, the strike price is $95. It's point B here on the line, or it's the vertical distance between point A and point B is the strike price in this case. Then you have a premium, what you pay for the option. So in this case, it's $3 a hundredweight. So off of this $95 strike price, you take off $3 and you get down here to $92 a hundredweight. That establishes the floor here at this $95 level. So all of this downside risk is transferred to the seller of the option. So that floor price is in place. The nice thing about a put option is if the futures price were to increase. So if we're going back in this direction here, you're out the premium, but you get most of the increase in the price level. So big difference between fixing the price at one point and having both the negative downside eliminated while still being able to remain in for most of the upside move. Makes put options attractive to manage risk in settings like the Fed cattle market. Now, what happened this spring was, this was roughly the situation in February, but when we got to March, April, May, only going to show the implication of an increase in the volatility. So the futures price fell during that time. That I've kept constant. Just what happens if the volatility goes way up. So here I take an at the money option from $3 to $9 a hundredweight, sort of understating what actually happened during that time. So that shift you observed was a move down in the floor price. So all of a sudden, what could have been covering a profitable what could have been covering a profitable break-even level was now not feasible, not sustainable, and it was costing much more in terms of an initial outlay to get coverage or price protection in place than it had been weeks earlier or days earlier in some cases. So put options with very high volatility are all of a sudden very expensive. Large cash outlays are needed up front to get into these positions, and the floor price may be unattractive compared to the break even. So just an all around rough situation. On top of that, during this past spring, the futures price fell at the same time, further pushing down the available floor prices. So it was bad news all around to go in after the fact. When this happened, we were looking for different ideas for what could be done. The best we came up with was to perhaps consider a synthetic put option at the time. That was taking a futures position at this 100 level and then buying an out of the money call, which would create a synthetic put, and that gave some upside again without as large of a cash outlay. It's not the greatest workaround, but it was something because these fences and stuff here, when the volatility gets this high, become really tough to get implemented as well. So that synthetic was probably about the best outcome we found, or risk management sort of strategy at that time. I want to highlight a couple of other tools. One is livestock risk protection. LRP is available on fed cattle. Much like buying a put option, it's insurance from the date you purchase it. It has deductibles instead of strike prices, and the coverage is available. You can see there 4 to well, they say 52 weeks out. That's not always the case, but you do have some coverage level that matches up generally with when cattle are on feed, and it's sold by insurance agents. That's a quick background. Now, what's changed about LRP? Well, starting on July 1 of 2021, so for the July 1 new fiscal year coverage on forward, the RMA and the USDA has increased the premium subsidy on livestock risk protection. They did increase it a little bit last year, but prior to a year ago, it was only 13%. So if you haven't looked at that product in quite a while, this year and going forward, the subsidy is 25 to 35% of the premium. So on a, say, an $8 or $9 hundredweight option price that you're looking at, 20 to 25 to 35% subsidy on that takes the cost down closer to, say, $5.50, $6. So it's enough to pay attention to, and large enough it really tips the scale from being indifferent between livestock risk protection and put options. Really gives the advantage to livestock risk protection as something to consider. You can also cover a small number of head. And the other thing they've done, it's an adjustment this year, the premiums aren't payable until the end of the coverage. So if you're buying a put option, spending $6, $7, $8, $9 a hundredweight up front, here you're paying $5, $6, $7 a hundredweight, and it's not payable. You don't need the cash until the end of the coverage period. So that too might give an advantage to considering livestock risk protection if cash flow is a little bit of an issue, or if you've got something giving you a positive return on cash. My opportunity cost of capital is it's hard to find something to say that money's worth getting a return somewhere. It's returns are hard to come by, but if you are in that situation, this might be another reason to consider livestock risk protection. So a change, another viable alternative. The last strategy I just wanted to highlight is an old strategy, and I was under the impression that when the volatility skyrocketed, it may have been unaffected. That's not the case, but I want to highlight a couple of things. This is what's happened to fed cattle 6 month ahead feeding margins. So this would be a paper trade. This would be a live cattle futures position, feeder cattle, and corn futures positions dictating a feeding margin. So it's a paper feeding margin behind the scenes, but throughout the last 7 years here, 8 years, how many years do I have? The expected feeding margin has fluctuated around $150 per head for 6 months ahead. So think about a combination. Roughly that's the feeding margin that's there after covering the feeder cattle and corn. So it doesn't cover roughage like hay or silage, and it doesn't cover yardage expenses, but it gives you an idea. That margin has been around $150 on the expected side of things. The actual margin, when it comes to the end of the feeding period or 6 months ahead, that has been all over the board. So you may remember early 2017, huge paper profit levels could have been had at that period. That followed equally huge loss period in late 2015, and here we are. The actual margin, this would have been during April, was almost $250 negative, or in the red at that time. So these margins have fluctuated tremendously feeding cattle, and that again is just indicative of the kind of risk that's been present or continues to be present in this market. The latest margins had come back up. The expected margin this last month So for delivery or for the actual sale time in January of 2021 was back above 150. This low happened in, what month was that? That was in April. The expectation was that that margin had been down below $78, $80, somewhere in that neighborhood. So just an indicator to watch. Here's the final bit of this take-home message for this. As those expected margins had been pretty good, as they fell, and this would have been the expected margin during April of this year for cattle to be delivered in September of this year, that margin got down to $80. So that's the same margin, expected margin shown on the chart before. And at the same time, when March and April and May, we had the big spike in implied volatility, that carried over to the premiums for livestock gross margin insurance. So livestock gross margin insurance in April would have cost you over $100 a head, and the expected margin was $80 a head. And that math just says, hey, that isn't going to work unless you're expecting minus $400 returns at the end of the day. So this isn't a way to get around higher volatility in the market. I thought it might have been a viable alternative, but looking back at the track record, it went, those premiums went up the same way the implied volatility did, or because of the implied volatility, and it wasn't a viable alternative. So what does that mean? I think you've got some forward pricing options that are alternatives that do work. There are some trade-offs between the forward contracting and futures. And then if you look at protection strategies, livestock risk protection would be a viable thing to consider, especially if you looked at it and it was close in the past. And then put options certainly would be something to consider, along with more complicated strategies. So that's the end of my formal presentation. I see my clock says we're doing okay with time. So if there are questions, highly recommend the email for contact. Most of the phones go to voicemail. So Olivia, I can stop or offer a few more comments, and so we wait if there are some questions out there.
Yep, I've got no questions at the moment. So anybody, if you have any questions, please put them in the chat or the Q&A box.
If I've got just a minute, then certainly type in a question if you have one. I was going to highlight one other thing. Oh yeah, one other thing that has happened in the meantime here, the volatility in the live cattle market has fallen back down to I'd call it almost near normal levels. So the volatility going forward from now to through the end of the year or into through the end of the year or into 2021 is back at a fairly reasonable level. So put options that were looking impossible to cash flow should be looking much more reasonable today. And that would make some of those combination strategies also look much more reasonable going forward. I did not cover any of the more complex margin risk. Could have, but if you look at corn risk and feeder cattle risk, those are real. At the same time, there's no concerns in the short run about the supply of corn, and the feeder cattle prices have, typically are following the live cattle prices as well. So that risk kind of gets swamped by the fed cattle risk, but there too, looking at call options on feeder cattle and corn would be another way to approach managing the risk in those settings. That's what I have for canned comments. So any last call for questions here?
Matt, I don't see any questions, so I think with that, we will just thank everybody for being here today, and hopefully see a bunch of you back next week for Dr. Smith's talk about growth enhancing technologies. So thank you all.
Thanks, everybody.